So today's topic is going to be about diversification and asset allocation and how to think like a fox. I know fox sometimes has that negative connotation and negative perception about how fox treats work in the environment and in the jungle, but we'll explain why in investing, thinking like a fox can pay a lot of dividends. So with that, we'll get started with a little bit of a kind of going back to what we started the whole webinar series with since the beginning of the year of where is the market going? What do we see in terms of the US economy, the global economy, and how does it impact the investment strategy for us and for our investors? So the first question we're going to pose is 2024 an extension of 2023? There was a lot of talk last year that 2023 was the year of pause. Everybody's waiting. Interest was high. Everybody's worried about what's going to happen to the economy and where it's going to go from here. And everybody was hoping that 2024 is going to be the beginning of ease, the beginning of the Fed movement on interest, and that 2023 and the late 2022 was the worst of the market. And now we're going to start into the new era of transactions, of movement in the market. So the first thing we covered is, the job market. The job market really quickly has been amazing. It's been fighting the Fed. The Fed keeps hoping that we have layoffs and the economy continues to produce jobs. And that's driven by the incentives that we're creating in the stimulus phase, but also by the massive shift of labor in the economy, moving away from certain industries to another, and also the wages growth. So what we've seen recently is, although the growth of jobs available in the economy is slowing down, we continue to see more jobs than people. Despite all the migration talk across the border into the US, we still see a big shortage of labor in the marketplace. So that is delaying the Fed action. The economy continues to perform well, and the Fed is waiting. The second piece is the inflation. The inflation has gotten down and started to get under control, but at the last result or the last report of the inflation, we're hovering right below 4%. They were hoping that we get into low threes. Their target is 2%, and that did not happen. And I think we're back to 3.9 in the last report. And so with these two combined, we do see that the Fed potentially gave a false hope on starting the reduction of the interest rate. A lot of the analysts were thinking that the Fed is going to reduce the interest 3 times this year, maybe a total of 0.5 to 0.75%, and starting in Q2, potentially into the second half of the year. But as I mentioned, as the economy continues to do well, the jobs continue to grow, and the inflation is not really under control, we feel more and more that the interest rates are pretty much here to stay. It's going to be high for long, is what they say. So we may still see a small reduction towards the end of the year, but it's looking more and more that it's going to be more of a 2025 phenomenon. So with that, the question is, okay, how do you navigate this kind of market? The market is going to be steady state. The owners of properties are not encouraged to sell because they're going to face a steep discount if they have to sell. And so that's driving a lot of non-transactions. There's less transactions. We continue to navigate the low transaction market, and most of the sellers are really desperate if they want to sell. But any owner who's owning commercial real estate and other assets are sitting on them until they see the other side of the market. And so the question is posed to our investors is, are you the type of investors who's going to sit and see this market move and go to the other side, after the election, after the economy settles down? Are you just going to hold on to cash and lose value of the dollar? Are you going to put it in gold, money market? Are you going to continue to invest and be opportunistic? And that sort of opens the door to this concept of, are you a hedgehog or are you a fox? And so, this uh, old analogy of, if you're a hedgehog, you're a big picture type of person. You like to stick to one strategy. You believe in that strategy so much and this is what you know, and this is the area of expertise that you accomplish over the year. And maybe this is an investment you had good luck and fortune with in the past, and you stick to what you know. And so big picture, stick what you know. Don't go deep, don't go thin and spread. And then the fox is all about the nuance. Nothing is stable, nothing is fixed, everything is moving. And how do you continue to navigate without losing sight of your main strategy? And strategy can continue to be the same, but tactics might evolve. So are you a fox? Are you a hedgehog? And this is kind of what we invite you to start thinking about when it comes to investing. The investor sentiment in general, we shared in the last webinar or the one before last, that there was a record high of dry powder, of cash, of money market, cash equivalent. A lot of investors are sitting on the sideline, basically. I think globally it's more north of $5 trillion of cash waiting to be deployed. So the investors are worried, are hesitant in general. Some are opportunistic and grabbing these discounted deals, doubling down on the fact that we're nearing the bottom of the cycle. But the majority of investors, I would say, are sort of paused, hesitant, not participating. And so if you think about asset classes and how people think about asset classes and why people are hesitant, are you in the equity side of things? Are you owning stocks or bonds? Do you see that inflated stock market driven by, 4 or 5 companies that are making the market look better than what it is? Are you afraid that this is the peak in the stock market? So that's one sentiment based on the asset class. Cash is losing its value with the inflation. Gold is soaring in the last few weeks like never before. So maybe people are anticipating. Crypto is soaring as well. So people moving away from cash. But at the same time, they're not really investing the cash. They're just holding it in a different commodity, if you will. So that's how investors look at the different asset classes and how they're feeling in there. So the next question is, how do you approach allocation? So if you are smart and you like to allocate your assets, what approaches our investors are using? Asset allocation sounds like diversification, but the difference is asset allocation is grouped typically by the risks and by the timeline. So it's, if your risk tolerance is high, are you looking into bonds, for example, where you're looking at annuity and dividends, but you don't care about the upside? If your risk tolerance is low, you might the other way. The risk high is you might be into new technology, startups, and other asset classes. But if your risk tolerance is low, you might be more interested in bonds and you don't care about the gain. So think about that as equities versus bonds versus alternative investments, and having the right portfolio under different risks, different time frame, and different return profiles. So a smart investors that are thinking like a fox would try to allocate their assets. And this is not just individual investors. This is private equity. This is university endowment funds, etc. This is people are trying to make sure that they're not putting all their eggs in one basket when it comes to equities, stocks, bonds, alternative assets, and cash or cash equivalents. So So that's one way to look at it, is diversify or allocate your assets across different risk profiles, different time frames, and different um, returns. But a lot of people, when you talk to them about allocations, they might be like, okay, we know stocks, we know bonds, but that's about it. Like, what else? And then people will be like, okay, maybe you should think about real estate. And real estate in people's mind is buying out a home and renting it and buying another one and another one and building that portfolio of single family homes. And maybe they haven't considered what's actually available out there, including buying shares in bigger real estate properties, like syndication, being a passive investor in a multifamily or a warehouse, or being a passive investor in a shopping center, for example, and being hands-free about it, but also still get the benefits of taxes and depreciation from investing in real estate. Another example is arts. People invest in arts and they buy certain pieces of arts and they hold them and wait until they find the right moment. There's a lot of pieces of art that have gained value over the years. This may not be available for everyday investors, but it's a lucrative place. Gold is soaring and it's coming back, and now they have ways that you can buy shares of gold using digital wallets instead of physically owning gold. So it's kind of like syndication, but for gold and for other commodities. Um, and then oil and gas, for example, people think that oil and gas investments are limited to big or medium-sized corporations, and those exploration rights and ownership of wells um, are strict to those kind of companies. But more recently, especially in the last 7, 8 years, this asset class has been more and more available to investors. So, uh, sometimes, people don't know what they don't know, but as they explore the way they allocate their assets, they can definitely go beyond the roller coaster of crypto and the roller coaster of stocks and the stagnant bonds returns. So just kind of food for thought for people to sort of think beyond the traditional asset classes. The next question is, can you de-risk your portfolio even further? And this is the difference between diversification and asset allocation. So with asset allocation, we talked about equities, cash, annuities, etc. Diversification is kind of dividing the asset class itself. So if you think about real estate, within real estate, you can diversify even further. Are you into multifamily, based on the asset type, multifamily, warehouses, industrial, shopping centers, medical offices? Is it geographically diversified? Are you in the Sun Belt? Are you in the East Coast, West Coast? Where is the growth? Are you owning all your properties in one city that can get hit by a hurricane, or prone to legislative restrictions? For example, there's a lot of migration happening from the West and the East towards Texas and the Southeast, and now South Midwest as well. So you can think about that. You can think about diversification within asset class. So you can invest in different asset types, different locations, different return profiles within asset classes. For example, when we do value add projects, we buy existing properties, we improve these properties, we improve the financial position and the value of the properties, and we normally hold these for 5 years. So, and it does cash flow and it's a stable investment, but we hold it for 5 years. Other investors love to invest in new development. It's a shorter time frame, typically 2 to 3 years, higher return profile, but no cash flow, for example. So some people mix it up between having new development projects and existing value add projects, even within real estate. So think about asset allocation at a big picture level, and then go down into within each asset, you can diversify even further. So the main advice here from our vantage point, and we use this in our everyday adjustment to our strategy, is you may still keep the strategy and you may say, you know what, I'm going to diversify in this manner and I'm going to asset allocate in this manner. I'm going to spend, put a little bit of my investment into equities, into new technology, into healthcare, big companies in the stock market. I'm going to put some of my chips into crypto because I see the market swing, and maybe it's more of a transactional exercise. I'm going to keep some money in the money market and continue to gain 4, 5, 6% interest until I find a great opportunity. But when I find a great opportunity, do I invest or not? So this is a strategy talk, and then tactics becomes more of a day-to-day decision making, or maybe a weekly or a monthly. Dep Depends on how active that investor wants to be or how passive. Similarly, different risk profiles, different risk tolerance might be related to age. How close are you to retirement? What is your take on the market? What is your take on your existing portfolio? Um, are you more into cash flow right now because you're close out into retirement versus maybe you're a higher risk taker early on into your career and you're taking bigger bets, for example. So the concept of balancing your portfolio is definitely important. But what's more important than balancing your portfolio is rebalancing your portfolio and keeping an eye on your objectives as an investor. Are you are you going to change your strategy every year? Are you going to change your strategy every 5 years? Or I would say tactics versus strategy. Are you going to continue to monitor the performance of your investments and make decisions based on the performance? Or are you going to continue? Do you have a set mind of, I'm going to wait and see, and I'm not going to rush a rebalancing exercise? One thing we love about real estate, if you're a passive investor, you're not one click away from making a decision on the investment side. In the stocks and crypto, we always make fun of that. You're one click away. So if you're emotional, you're gonna make a bad decision on the upside or on the downside. So are you the type of person who will continue to monitor the performance of your investment and continue to change? Or are you more like, hey, 3 to 5, let me see where it goes, and then make a decision after that? So focus on the balancing and the rebalancing side of things. So how do we apply this to our own strategy as an investment firm for our investors? We continue to look at the market. We continue to look at the macro view of the economy, the micro view of our target cities and states and asset classes, and sort of learn from those and sort of adapt our tactics. Let me see, the screen is frozen. Okay. If it's not obvious, diversification is key. We don't promote that people continue to change their strategy, moving from asset class to an asset class. We built our foundation at InvestStream at multifamily and residential, both on the value add side and most recently on the new development side. But I would say the fundamentals are the same. Focus on the right assets in the right markets and stick to the fundamentals. This is not an opportunistic market in terms of, this is not going to be a market where investors are going to be lucky. We believe that it's going to be steady state for a while, and investors needs to be very selective, but they shouldn't hesitate when they find the right opportunity to jump in. So I would always say, I'm more optimistic than ever that this is the right place for us as InvestStream and as a company. We've been in this business for 3 years now, and I would tell you that we are a lot more opportunistic these days than we used to. There's a lot of people on the sideline and that are not investing, and this is the time for us to jump in. And the reason for that is, we always look at the market as cycles. And 2024 is kind of like the extreme end of the cycle. We believe that we're nearing the bottom line, the bottom of the market of the cycle. And I mean, like I said, multifamily properties that are on the market, they're discounted already 25, 30%. Offices, we've seen 40, 50% discounted. We're not into offices. We're focused on multifamily. Industrial, although very strong, it started to cool down and become normal. And similarly is retail. It's calming down and becoming normal again. So our approach is very selective. We used to say, for every 100 property, you get one. Right now, this can't be more true. As we continue to look at a lot of properties, but we're a lot more selective in our criteria. But at the same time, we can't wait too long. So we're hungry to find deals as they come. And we start to expect some activity in I would say, we used to say Q2, now it's looking more like a Q3. And so we're starting this calibration process of our investment strategy. And what we expanded into is industrial. We have a couple projects that are in the works in the industrial space, and especially in the light industrial, office, warehouse, and small single tenant warehouses. They continue to be the darlings of real estate today. We love Texas. We're going to continue to play in Texas. Everybody's moving to Texas. The best two cities in the US are in Texas, Houston and Dallas, and we're going to continue to play there. Recently, because the East Coast have sort of inflated too much over the post-COVID investment cycle, and even Arizona and Denver on the other side, we see a sort of a bigger adjustment happening in these markets. And that sort of opens the doors for Midwest and South Midwest. And we love the Oklahoma City market. We love the Kansas market. And we're going to continue to expand into those, but sort of stick into what we know with a minor tweak. One thing on the partnerships, I would say, over this turbulent time of the industry, and you hear a lot about like who did what and what did they do wrong, and the news articles start sort of shooting people left and right. And one thing that we're really changing is we're very, very careful of who we work with and the partners we bring to any deal. There's a lot of small players that maybe join the market because of the gurus, and they got super excited and they made the bad decisions in their investment criteria. There was a lot of big people who got comfortable and relaxed a little bit and took bigger risks than they should have. So more than ever, we're really very careful about who we partner with and to make sure we limit the exposure of our investors from what's happening in the industry. Luckily, we started the whole investment journey post, I would say, the sugar high era of the investment cycle, where everybody was overbidding and taking risky loans because we launched right after that. But it can happen to any investor when they feel relaxed. If they're stagnant about their approach, or if they take higher risk than they should. At the same time, also, we're trying to stay away from the startup concepts, anybody who's still new in the market and haven't seen the good and the bad and the ugly in the market. So I would say overall, more stabilization around sticking our ground on how we underwrite, what markets we work in, what asset classes we look at, and we don't need to be creative there. But at the same time, being nimble and finding what works. For example, on new development and construction projects, we look at Houston and Oklahoma City market primarily for new development. And, interest rate is higher, construction cost is higher, and rent is pretty much flat, and operational expenses is higher. So if you look about it that way, you're like, okay, nothing is going to work. But if you find the right zip code where the rent is still growing in the suburbs, and you're navigating construction with creativity, working with the GC and working with the engineering and the architecture to do value add on the construction cost, you still can operate in this market. And this can't be more true than a project we launched last year. It's called X Space. It was a unique idea. It's kind of luxury condos in the highest zip code income in Houston, where everybody was not building retail, and we ended up building this new luxury condos. sort of against the grain of, because we have premium rent and premium sale price that can compensate for the interest, the hike in interest and the hike in the construction cost. So overall, people can, paint with a broad brush and say, oh, nobody should be developing in 2024. Just like they said, nobody should be developing in 2023. But if you focus on the right markets and the sub-markets and sometimes the zip codes, you still can find ways to make, to create opportunities for your investors or for our investors to invest even in this market. So I covered most of these items. Location, we talked about above national average for job growth and population growth. Property type, multifamily, light industrial. Property conditions, if it's a value add, we like stable projects. We don't need to take higher than average risks. Even though it might yield more returns, we don't need to be creative. We do want to be creative in the interest rates and the financial market. We work with owners to create a win-win situation, navigating, working through seller finance or giving them a piece of our own investment as a delayed payment to them, because if they sell as is today, everybody's going to lose. They're going to lose their money. The bank is going to lose a little bit of money. And it's not an easy situation for them to give up their properties, given where the market is today. So we try to navigate with them, okay, what can work for them and what can work for us without involving the bank. And maybe that's a situation that can be a win-win for us and them. With that, I'm just going to wrap it up, talk a little bit about what we've done so far, but feel free to start typing your questions. I'd love to hear your thoughts on diversification and allocation. A little bit about InvestStream. We started focusing our investment strategies on multifamily. As you can see here, our first 3 projects were multifamily value add acquisitions. And those are typically 3 to 5 years hold. We buy stable properties. We improve these properties. And the projections on these projects are typically 80 to 100% over 5 years. So that kind of gives an average of 15 to 20% annualized returns. You get tax benefits from depreciation. You get cash flow throughout year 2 through 5. Typically, year 1 is takeover year and stabilization year. And then you get the upside on the exit. Last year, we started working into new development. So we had two new projects where we did new development. I talked about X Space and another multifamily development in North Houston called the Hangar. The different profile there is you get a little bit of a higher return projected from 21 to 22 to 23. At a higher level, it can be 28%. So a little bit higher return, no cash flow, no depreciation benefits and tax benefits. So it depends on what our investors like. Some like, 1 to 3 year investment and they get their money back. Some like 3 to 5 years investment and they have a long-term strategy and they don't care about, getting their money as fast as other investors would like to. I managed to recruit my dear uncle into the process, and he has been big on development projects in Oklahoma City. He was an owner operator of multiple national hospitality brands, and over the years he was kind of like my mentor, and he's the one who instilled the virus in my head of development and real estate, and I'll tell you why. But he built his own stores, and now we're bringing that huge experience of development into the team, whether it's retail, multifamily, or office warehouses. And because I like greenery, it's not going to be renewable energy or windmills. My background has been in oil and gas, and I was one of those investors who never said, I'm quitting my job, I'm going to real estate and no more working in my past career. I would, spent 15 years in oil and gas before coming back to what we're going to be sharing with our investors soon. We're going to be bringing oil and gas investment opportunities for our passive investors. Now, oil and gas has different unique attributes to it. Kind of talk about risk tolerance and return profiles. Oil and gas are typically higher risk but higher return. The multiples on the equity can be double what you get out of real estate. The cash flow is a great phenomena. You get a lot more cash flow as well. But it's a higher risk. You know, when we go to a project and there's like 50 to 100 wells to drill, you know, you might have few wells that are not producing as expected. But at the same time, it's a lot higher return in terms of cash flow and multiples. You get depreciation, actually much stronger depreciation than multifamily, because that depreciation can offset W-2. So a lot of high income earners that are relying on W-2 jobs, they love oil and gas because they can actually offset their income with their investment. So again, talking about diversification, oil and gas offers higher return, higher depreciation. It's a higher risk profile, but it's also more lucrative. So more to come on that. We will be sharing more details once we have the deal finalized, but it should be coming soon, and we'll be sharing that with our private investors in via emails and text. A little bit about the team. Like I said, we've been doing this real estate, commercial real estate, and syndication projects for our investors for the past 3 years. Before that, I was 15 years in oil and gas, had 2 startups, multiple business acquisitions, and business transformations for a lot of acquired businesses. Focus on technology, marketing, M&A, and business transformation. My business partners in crime is Dr. Baha and Dr. Youssef. They're my brothers and cousins. We've worked together on multiple things. You know, they have this entrepreneurship knack into them, and you know, we always help and challenge each other to do more. Baha has been in the medical field, but he's also had been in multiple different businesses. Yusuf as well as a pharmacist, quit Walmart and being, you know, one of the top managers nationally, created his own consulting business in the medical field as well. And so kind of put the little fund together and started this journey about 3 years ago. And from there, we continue to expand the team. I talked to you about Wes. We now have Marquise as well. He's helping us into the Houston market and finding those beautiful lots that are not being looked at by other investors, finding these stories in the investment world where we can create a win-win situation where maybe other investors aren't looking into because they think they're not going to work. And then continue to expand the team around marketing, acquisitions, and outreach to our communities, etc. So with that, I'll pause here. I know we have 8 or 9 minutes left, so we'll open it up for Q&A. Sammy, I don't know if you have any questions in the box, and then feel free after that to unmute and ask your questions.
Yeah, we've got one question in the chat to start. Ferris asked, buy what, real estate stocks or diversify in all asset classes?
That's a great question.
That's what I said.
I'm going to be biased, Ferris. I mean, what we offer is real estate and potentially oil and gas now. So I'm going to be biased toward what I call them alternative investments, right? It's moving away from stocks. If all you did is stocks, I would encourage to start thinking about other things. But the overall strategy that I recommend is diversify. Always diversify. Don't put your eggs all in one basket. Diversify locations, diversify managers, diversify asset classes. Now, you'd have to think about where you are in the journey in terms of retirement age. Are you gonna take higher risk, or are you the type of person who don't want to do a lot of risk, but maybe steady return. So the short answer, it depends. It depends on the investor and their appetite to risk and what they're trying to achieve in the investment strategy. But diversify is a constant for sure.
No other questions in the chat yet. Anyone else have anything? Can unmute as well.
Thank you so much for this presentation. So you mentioned a little bit about oil industry and that it can help against high earners with high W-2 income. Can you elaborate a little bit more about it?
Sure. So oil and gas and agriculture, meaning winery, vineyards, etc., are incentivized by the tax code. This is very ancient, to incentivize developers into developing oil fields and agriculture. There's a specific, and I can't recall the specific tax code, but it's very old, that you can depreciate indirect cost of the development against W-2 of the investors. So if you recall, in multifamily and other asset classes, normally if you buy an existing building, you can depreciate an existing building and benefit from depreciation. But depreciation only works against your capital gain. It doesn't offset your income. The incentive in oil and gas is not only development, you can actually depreciate development. Typically, you don't depreciate development because there's nothing. You have land and now you're spending money to develop something, so you can't depreciate. But in oil and gas, they allow you to depreciate the indirect cost, like the engineering services, the rig, rent, anything that is not the physical well and the casing, for example. So now that's one. So you can actually depreciate development that's unique to oil and gas and agriculture. And the special tax code allow you to offset your W-2 income. So if you invest 100K, for example, in an oil and gas deal, you would get maybe 50 to 60% depreciation in year one. So you'll get a negative paper loss of 60,000 you can offset your income with. So that sort of helps at least, recoup some of your investment money, at least on paper, and use that against your income and lower your taxes. And then you start enjoying the cash flow in year 2, year 3, year 4 as any other investment. So that's very unique to oil and gas and agriculture.
And that is statewide, right?
That's across the nation, correct.
Okay. All right. Thank you. There are projects coming through in this field.
We are working on one. I'll tell you it's coming soon. I'll share more details as we have it landed, but it's coming. So we're working on an oil and gas project in Texas, yes.
Okay. Well, if we do not answer, send us text messages. Sometimes we get lost in those, emails and WhatsApp groups, and we do not pay attention to every single message that comes through.
Yeah, we try to balance, definitely. But we try to balance not annoying people, but also keeping them informed. So I hear you.
Thank you. Thank you, Alan.
Yeah. Okay. Regard to real estate. So real estate, yes, you get depreciation only on existing buildings. So in real estate, we either can develop a new building and we don't get depreciation on developing a new building, but we get depreciation if we buy an existing building. So if we buy a multifamily, like here in the picture, we buy this property, we hold it for 5 years, we improve it, we will actually gain depreciation. And it's a similar equation for the most part. So if you invest 100K, we'll get in year one a depreciation between 50 to 60%. So 50 to 60K, depends on the project, but that's a general rule of thumb. And that will be a negative K1 paper loss distributed to the investors. The only difference here that this negative K1, you can only use it to offset capital gain. You cannot offset your income. You cannot offset it You can't use it against W-2. You can't use it against 1099. You can use it against other gains from other investments. And normally we say work with your CPA to understand the nuances of that. The good thing about multifamily and real estate depreciation is you can always work with your CPA to postpone filing that negative K1, meaning that if for some reason you don't have gains that year and all you had is income, you can postpone using that negative loss until you have a year of gain and then you offset it. So that's the beauty about it. So you don't lose it. You may not use it if you don't have gains, but you can always use it down the road when you have gains to offset. And if you don't have any gains, you can always use it when we sell the property and you get the big gain from that specific property. So in year one, we bought a multifamily property. You get the negative K1, you decide not to use it. But guess what? You can use it in year 5 when we have the big gain.
I also added the how to underwrite deals like the pros webinar recording from last month. And you mentioned the underwriting process. That was a really great one. If you didn't check it out, I would recommend watching that for the thought process and approach to analyzing deals.
Yeah, that's a great point. We go through the details of what zip codes we look at, what markets, how do we analyze the streets, the amenities, what's happening around you, the schools, the crime, etc. And then dig deeper into the actual property and the potential. And we're in the business of making our investors money. We're in the business of enriching our investors, freeing their time. We're in the business of enhancing the lifestyle of our communities. So we make sure that we pick the right properties where we're really going to make a difference on the community, but also to our investors' money and time. So we don't take that lightly, and we make sure that we, like I said, skip 99% of opportunities to make sure we land the right one for our investors. All right. Well, thank you very much for joining us today, and we appreciate your attendance, your questions and feedback, and would love to see you in the next one in May. Have a great evening.